American household debt has reached a record of almost $17 trillion at the end of 2022. So can you explain what the debt to income ratio is, what that ratio should be, and why it's important to stay around that number?
The debt to income ratio is really the portion of an individual, or you can look at it as a couple's monthly income that goes towards paying off debt services. So those could be your mortgage, credit cards, auto loans, all things of that sort. You could take the total of all your monthly debt payments and you would divide that by your gross income. If you calculated your debt to income ratio, you'd like to see that either at 36% or below that mark. And it's really important to keep that debt to income ratio as low as possible because it makes you more attractive to lenders. Lenders typically won't issue you a mortgage if your debt to income ratio becomes higher than 43%. So somewhere in that 36 to 43% range, you're sort of maxing out on your debt utilization and your attractiveness to lenders.
There are some common strategies out there. Megan, would you talk through some of the most popular ones?
Across the board on a monthly basis, you're going to be wanting to make at least the minimum monthly payment across all of your different debts. There are two main strategies that I think people know of when they think of paying off their debt. The snowball approach is where you look towards paying on your smaller debts first. And an advantage to this is that it helps you build momentum because you're paying off the smallest balances first. You start to see debt kind of disappear quickly. One of the drawdowns to the snowball effect, the snowball tactic, is that it costs more over time just because you are looking towards paying off the smaller balances, as opposed to with the avalanche method, you're really looking towards paying down debts with the highest interest rate. And the goal there is to pay less interest along the course of time. One of the disadvantages to the avalanche tactic is that it can take a little bit more time to see results, especially if those higher interest rate debts also have higher balances. But again, this is mathematically the more suitable course to take if you just want to pay less in interest over time.
How do we as advisors add value in this space?
I like to think of this in sort of the 3 A's: action, accountability, and then appropriateness. Looking at action, an advisor can really help you sit down and look at your budget. So your monthly income versus your expenses, and they can really help you to look towards additional opportunities to pay down that debt faster. In terms of accountability, I think it's really helpful for both the client and the advisor to know when you're working towards paying down debt. It's really helpful to be able to come back and share milestones in paying off your debt, and then just to get that additional level of satisfaction and see, even the effects in your financial plans and how paying off debt is going to make differences for you long term and in the future. Appropriateness, or determining appropriateness. I think it's really helpful to have an advisor when you're going through big life changes or making, purchases. So in terms of looking at the current interest rate environment, it might be really helpful just to bounce ideas off your advisor and say, does it make sense for me to finance this investment where I could really self-fund it? And looking at whether or not the current interest rate environment plays a role in that decision. And then on the opposite side, if you are maybe looking to refinance a home or do something like that, there are additional costs that come with refinancing. So the disparity between the current interest rate that you have and the new interest rate that you're going to get has to be large enough to justify those refinancing costs. And an advisor can help you determine that.